Okay. So that's it. So I know you our last this we did introduction to cost and management account. Now we are supposed to take only management accounting since you have adequate knowledge in cost accounting. So we'll take management accounting and go into details. So let's see, what do you know about management accounting? Management accounting and cost accounting, are they the same? If not, what is the difference? What's the what do you know about management accounting? Or what's the difference?
Hello.
Yes, madam.
Please, I will say with the difference, the cost account as we did is control of costs, recording costs in the business. For management to take decision, so it's involve money, only money, but with the management accounting, both financial and non-financial information gathered for management to take decision in a business. That's right.
Okay, good. Any other person? Any other person? All right, so as she said, so with the cost accounting, as we know, it focuses on controlling costs or ascertaining costs that you use in production. Then for management accounting, it focuses on providing information to support planning and then for decision making. Even though you can also use that information for controlling. Then managing cost accounting also is concerned with cost collection. Yeah, so you collect information about cost, then you classify that information, then you allocate and analyze the information. But with management accounting, it uses the cost information that you have gathered for financial and non-financial decisions. Yeah, so the main objective of cost accounting is to ascertain cost and then control. And the main objective of management accounting is to help management make effective decisions. Effective decisions. So cost accounting is kind of narrow, okay? It's narrow because it's concentrate mainly on the cost. Then management accounting is broader because it covers budgeting, it covers forecasting, performance management, which we are coming to look at here, then strategic planning, and then risk management or any other area that is relevant for management decision. Okay, so with the cost accounting, it will give you detailed reports on product jobs, let's say product cost, job cost, department cost, or process cost. You see the things that we treated. Then for management accounting, it will give you report on budget, to give you report on variance analysis, that is unit 6 standard costing. It will give you reports on a performance reports, that is unit 4. It can also give you report on investment appraisals. That one I've deleted out, so it's not. So, and budget. So that is the difference between management accounting and post account. Now, so for the purpose of management accounting is for decision making, management decision making. So we would ensure that yes, we make decisions to help the organization run. To help the organization run. So management accounting uses both financial and non-financial information. So the financial information is the one that includes money, and non-financial information is the one that does not include money. You cannot express a figure on it. Yes. Then the purpose specifically to help management determine and ascertain cost to various cost units. So you want to know the cost price, okay? To know the cost price, that is one purpose of management accounting. Then to provide useful information for planning. So you need information for planning and controlling. It's management accounting that will help that. To also determine the overall returns. Okay, the returns on the investment that you have taken, like yesterday we were talking about return on capital employed. Return means profits that you are getting from the investment. That profit you are getting from the investment technically is called return. Then also provide information for management evaluation and continuous improvement. Then you also provide information for management decision making. So decision making, then it will help you avoid underutilization of resources, because you are supposed to utilize the resources to the maximum level, optimize the resources so that you can get the benefit from it. But if you have the resources and you are not using it well, you are incurring costs. You need to utilize the resources well so that you will gain more benefit from it. So there are so many purposes of management accounting, including this ones. Okay. Now, the relationship between cost accounting, management accounting, and financial accounting, okay, which I think we did some, but just to recap what we know, financial accounting is mainly for external users. Okay, they give reports to external users such as shareholders, creditors, government agencies, and the public. Then it focuses on historical information. So the information that is past is what financial accounting focuses on. Then those information is used to ascertain the organizational performance and then financial standing. To know the financial standing, you would be able to so you would prepare your balance sheets or statement of financial position. to know your financial standing at the end of the year. Then cost accounting, okay, it allocates resources as we have just gone through the difference between cost accounting and management accounting, which cost accounting is narrowed, focusing on the costs related to the products or the specific cost. So here, the resources that it allocates, it covers material costs, labor costs, and overhead costs. So this is the narrow focus of cost accounting. Then the purpose is to determine the cost of operation and identify areas for inefficiency. So the main focus is cost of operation. What is the cost related to that? Then management accounting, as we have looked at briefly, is higher than cost accounting, is broader than cost accounting. So here the main purpose is to get financial information for management decision, to decide what they will do in the future, okay, and to plan for the future, okay, so that the company will continue to operate well. Okay. So the difference between financial accounting and management accounting, which was part of your exams, right?
Yes.
I hope you are able to answer it well. I think I've already listed the points I want you to use to differentiate them. So even though I haven't marked your scripts, I expect that when you pick it, you pick the point, you tell us the position of financial accounting and the position of management accounting, right? So these were the expected answers. Beyond that, whatever you write, if it makes sense, that is fine. So in terms of regulation, law, okay, financial accounting is governed by laws or governed by regulations. What are the laws and regulations? It is governed by Companies Act. It's governed by accounting standards. So if you mention that, that is fine. Then management accounting is not governed by any regulations. That's all. The nature of reports. So I think that one was not part. Financial accounting reports are general purpose, and the management accounting reports are what? Specific purpose. So general purpose means you prepare financial statement and publish it on your website. Any person can access it. You don't have to go and request for it before you are given. So if you go to the website, for instance, of GWEL or MTN Ghana, you would see that the financial reports, statements for the last years are all on their website. So you download it, go through and make a decision. But you will never see management accounting reports on their website unless you go and request for it, which you will not even give it. They won't give you because you are not part of management. So it's only management of MTN Ghana who can request for management accounting reports. So that is it. So in terms of the nature, financial accounting is general purpose and management accounting is specific purpose. Then level of detail, financial accounting provides broad overview. It is not into details, so it's the aggregation of figures. Okay. But management accounting provides more detailed insight. So here you will take one information, you break down all the costs related to that information. The financial accounting will add all the costs and get one composite figure for all the information. Sales figure, for instance, if you go to the organization, you go to the financial statement of a company, you get only one figure as sales. But does it mean that they have incurred only one figure throughout the year? No. But in a financial accounting, they add every figure that belongs to one classification as one. The management accounting, no. You can go details and get specific sales figures. Please, I'm coming in a minute. Okay, so let's continue. All right. So, what do you have on Saturday morning? Please, can you hear me?
Yes, please.
Yesterday morning, what class did you have?
We had a company and a partnership law.
Okay, company and partnership law. Did it come off?
It came on.
Okay. All right. I thought he has changed the time with you. Like I would have let us shifted the accounting to the morning. Because accounting in the afternoon, yeah.
Yes,
Hmm. Talk to him and let's see if he will swap. Because accounting in the afternoon. Now we are coming to do consolidation to be something.
We are doing it with management students also. If you want to talk to him, yeah,
Yeah, to a great problem. To a great problem.
yeah.
Okay. It's fine. Don't worry. We'll manage. So another difference in terms of reporting intervals for financial accounting, you report at the end of the year. So it can be yearly or it can be semi-annually or quarterly reports. But for management account, has no specific time, can be requested by any time, okay, by management. As and when it's requested, you prepare it. Then time horizon for management, for financial accounting, it focuses on the past or historical costs, okay, historical costs or past information. That's why accountants are always dealing with dead, I call it dead information. Some people have chopped the money and you are still working with the papers here and there. Meanwhile, the person has finished consuming the money. So as an accountant, you'll be dealing with even 5 years information, 5 years payment you have made, 4 years, 3 years, when that amount has already been consumed. So it focuses on past information or historical costs. The management accounting, okay, it can include future information or expectations or some aspect of historical cost. So it focuses on past, current, and future. So that's why in accounting you don't see budgets. Have you ever seen budget in financial accounting? Who has ever seen budget in financial accounting topics? Okay, so that is it. So management accounting prepares budget. Now there are tools that you can use in management accounting, which I mentioned earlier. There are so many tools you can use, including break-even analysis. So let's look at what break-even analysis. But before that, if you have any question, ask before we move to unit 2. Any question? All right. Now, I know you have heard break-even analysis because all of you did accounting at SHS level, right?
Good morning.
Morning. You did accounting at SHS level.
Yes, sir.
Okay, so what do you remember about break-even analysis?
A
Anything?
situation,
Mm-hmm.
as a situation whereby you don't make profits and you don't make loss too.
Okay, so you break even. So at break even, what and what are equal?
Total revenue and total cost are equal.
So at break even, total revenue is equal to total cost. That is good. You still remember? Yes, you still remember. And do you remember any formula for break even analysis? Okay, so if you do remember formulas, or you remember?
No, forget me.
Okay. All right, so break-even analysis, okay, is a term that you use in studying or analyzing the relationship, okay, in the relationship between these three variables: cost, volume, and profit. The movements among the cost, volume, and profit, okay, is in the form of study is what we call break-even analysis. And then higher level, we look at this relationship as cost, volume, profit analysis. Cost, volume, profit analysis. Now, cost, volume, profit analysis It's also the detailed connection or relationship or relationship that you connect the cost to volume and to profit in the form of continuous relationship. If one changes, then it's the other may also change. Yes, sir. The other may also change. So that is the relationship that exists among them. Break-even is a good tool for planning. Management use it to plan so that they will know what quantity to produce at what price. They will know that this quantity, that's the level of quantity that will produce in order not to make a loss. The quantity that if we overproduced, we are going to make a loss, not because the units are not available, but because you have overproduced. So if you have overproduced, though you will sell, the remaining cannot be sold. Okay. So they would also use break-even to know which point we should sell, the minimum we should produce, and the maximum we should produce. That will create what we call margin of safety. So the break-even analysis will help them to know the level they will operate in order not to make a loss because of underproduction, and also not to make a loss because of overproduction. So there are assumptions of break-even analysis here. We have many of them. So everybody will get 1 point. So everybody will get 1 point to explain. So you are 8 here, right? 8. So nobody should run away. Yeah, 8. So we have many of them here. Please pick one, read, then tell us what you understand by that assumption. Who is starting? Please take one and read.
Please, Doc, let me start with the first one.
All right, go ahead.
All costs can be segregated into fixed and variable elements or components. Well, I think the costs, when we talk about fixed costs, they are costs that does not change with changes in volume. So when it increase production, fixed costs remain the same. When it comes to variable costs, they are those costs that change as we change unit produced. So they vary with the output. So the more we put, the more cost we incur. Thank you.
Okay.
Hello, Doc.
Yes, madam.
So please, I will take the H. There is
Okay.
no change in price in the general. There is no change in the general price level. Since it's a
Okay.
break-even, the price remain constant. There is no change. There's no increase or decrease because we want to break even. There's the prices remain constant. There's no change in it in the
All right.
general. Yeah, thank you.
That's good. That's good. Who is next?
Please, I can't see your screen now.
Everybody cannot see all. You alone.
I can see. I can see.
So you leave and join again. By the time you come, you to get your point. Yes, the rest, please speak your point and explain.
Yeah, I'm picking C.
C, okay.
The only factor affecting cost and revenue is volume. That is price, is fees, as well as cost. So it means the only thing that affects the money that is generated by the company or the money that they pump into their activities is the volume of the units produced. So the price and the cost as in per unit is always fixed.
Okay. Okay. So you assume that price is fixed, cost too is assumed to be fixed. Okay. Cost change based on volume. Okay. And then revenue also change based on volume. If the volume does not change, cost will not change, the revenue will not change. That is an assumption. Okay. Who is next?
I will choose.
You said
I'm I'm going for B.
B. All right.
Yes. Fixed costs will remain constant and variable costs will vary proportionately with activities. The
Mhm.
variable cost per unit is constant.
Okay.
What it means that fixed
Mm-hmm.
costs always remain constant. So
Mm-hmm.
the quantity we produce depend on the variable costs per
Okay.
unit. So the more we produce, the more incurred costs, the variable costs will increase. The less the variable costs will decrease.
Okay. Good. Yes. So you have been able to explain it well. So if I ask this question, in break-even analysis, okay, variable cost per unit changes, but variable costs remain constant. True or false?
True.
So in break-even analysis, variable cost per unit changes, but variable costs remain constant. True or false?
False.
Why true? Why false?
From what we have read from B, they said the variable cost per unit is constant. It means it doesn't change. But the variable cost itself vary proportionate with activity.
Okay. So I've just changed the position. So variable cost per unit is constant. You need to know that. Then variable costs, okay, changes proportionate with the activity. Variable cost is not the same as variable cost per unit, too, right? All right. Yes, who is next?
Hello, sir.
Yes, sir.
Yes, I'm taking the E.
All right.
The technology, production methods, and efficiency remain unchanged. So it means
Okay.
that under break-even, we assume that there will be no new technology introduced and then production methods that are being used to produce products will not also change,
Mhm.
and our efficiency will also remain the same
All right.
in our production process.
Good. Some of these assumptions in reality are they true?
So I think maybe in the short run,
Okay. Yes. So who is next, please? Oh, that's all. Who is next? Please pick the point and read and explain for us. So it's left with three. Anyone can pick any of them and explain. Okay, so the D says over the activity range being considered, cost and volume, cost and revenue behave in a linear fashion. So those of you who are familiar with mathematics equation, quadratic equation, right? Linear equation, quadratic equation. Do you see that? With the linear equation, it is the line is straight on the graph. True or false?
True.
And then with the quadratic equation, the line keeps curving, right? It's not straight. It can go up, down that way. So since you know that. So we are saying that with break-even analysis, it behaves in a linear fashion. So the lines are straight. So total revenue line is straight. Total cost line is straight. They will meet at a point, and that will lead to break-even points. And you trace it to the break-even units, and then break-even uh, break-even point in volume, and then break-even point in CDs or revenue. Then fixed cost line is also straight. So that is that. So look at it, this one. So this is sample of linear fashion. So the total revenue is straight. Then, sorry, total revenue is straight. Then total total cost is also straight. Then fixed cost is also straight. Right. Then the next one is the analysis relates to one product. So here we are dealing with one product only. Where there is a need for us to consider product mix, we will use different assumption and different calculations, different with part of it. So we'll do product mix on where we have more than one product. So here what we are saying is that the assumption you are making, you should make it in relation to producing only one product. Okay, it should be one product. So if you are producing standard water, okay, so this assumption applies to producing standard water. But if you are producing yogurt, and what are the classes you can find in yogurts? Those who sell, what do we have inside there?
So we have the yogurt, we have the Fun Nice, we have the Fandango, yeah, and we have the mango type. All of them are related.
Good. But do they use the same raw materials to produce them?
No.
Okay. So in that case, that is product mix. So the break-even analysis cannot work unless you pick only yogurt and you do break-even analysis. But where you are producing that at the end of the day, it is coming out with several products, or your production is in a program way that it produces the 4 that she mentioned, or even 2, then break-even cannot work. And these assumptions cannot work. You have to change it to product mix. The last one is there is no stock level changes, or stocks are valued at marginally cost only. So we did the stock level changes, minimum stock, maximum stock, right? Reorder level. So we are saying that these levels will not change. Stock level is the same. Okay, it's an assumption. Stock level is the same. So there wouldn't be any reduction or increase in stock. Okay. Now, do you think that these assumptions are valid in reality? Who can critique the assumptions? Pick any one of them and bring your critique it and let's see. What are the limitations of the break-even analysis?
So I think they are not always valid.
Pick one and let's speak to it.
Like variable, I will say variable costs per unit may change. For example,
Wait. Oh. Which point did you explain? Or you couldn't explain any?
I didn't explain any, but
All right.
I'm
So,
thinking about. I wanted to explain the first A, and someone
okay.
explained. My line went off.
Okay. So let's do it this way. So pick the one you explain and negate it. And that becomes the limitation of break-even analysis. Who explained the first point? Don't worry, if you can't, we'll help you. Don't go and hide. So the first point, who explained it? What about the second point? You are run away or you can't hear me. Please, can you hear me? But you know the one who explained the second
Yeah,
point.
sir, we can hear you.
Okay. So just pick your points if you are ready to give us the negative aspect of the assumption you gave. Just
Hello.
question, critique the assumption you gave us, and let's see. Yes, go ahead, boss.
Okay, my point is the only factor affecting cost and revenue is volume. That is prices, fees, as well as cost. But it doesn't happen in all situations like that. That if, let's say, if the volume is high, then you make more revenue, and if the volume is less, you make less revenue. When we want to bring economies here, sometimes the volume can be low, but the demand will be high, and the price, which is fees, will go up. So you make more revenue and the volume will be low.
Mhm.
I think.
The opposite.
As in the opposite, as in
The volume can be high, but
yes, the volume can also be high, and so if the volume is high, because more products are in the system, maybe the demand will be low and the price will also be low, will not be at the fixed as it is.
good. So that assumption is not valid throughout. Okay, that's good. Yes, and then I say that price is fixed. What do you have to say about that? Is price always fixed?
No, price is not always fixed. Sometimes price vary with demand.
You see. So in that case, you cannot, this assumption is invalid throughout. Okay. Yes, thank you very much. The next, who is next? Just question the assumption.
Yes, sir. So the technology in this day and age, this assumption, as far as technology is concerned, is just not valid at all because technology has gained momentum and has been changing frequent as easily as possible. So
Good.
if as long immediately technology changes, automatically the production quantity of production will increase or may decrease depending on the kind of technology that was introduced. Then production methods when technology change, our production method will change, and then the efficiency of even the labor may also change if even one labor is sick or an efficient labor is introduced into the labor force. So
Wow.
this may it's
Good.
just not valid in real time.
Good. You have really explained it well. That's it. That's it. So who is next?
Hello, sir.
Yes, madam.
Okay, so with the age, there is no change in the general price level. It's not always constant that there is no change. Even though it's a marginal, we are breaking even. There will be slightly price change, but not too much, so that it will be able to move through the economy, because depending on what is happening in the in the um, in the economy, and it also depends on how we want our products to also go. So when we are able to look at the costs and all the expenses that we have incurred, fine, even though we don't want to make much profits, there is sometimes slight difference in price, even though it will not be huge. So it's not always that there's no change in price when it comes to break even. Rather, even though we are not making much profit, there is a slight change of price in the products.
Good. So it's not true that price level will not change. In reality, that is not what is happening. Okay, good. Yes, who is next? You can pick anyone and explain if you think yeah, not necessarily the one you have earlier explained. You can pick anyone. So Rita, which one are you talking about?
I talk about the analysis relate to one product only or to a constant product mix. And most businesses, they sell multiple products. So the sales mix often changes over time.
Okay. Yes. That is good. Any other one? So the first one, all costs can be segregated into fixed and variable costs. Are you sure? The
No.
business you are doing, can you say, do you know the fixed cost? Do you know your variable cost? Are you really sure that you can segregate the cost into two perfectly?
No.
So that assumption is not valid throughout, because in reality, you cannot separate certain costs. Sometimes some costs are there, you don't know whether it is fixed cost or it is variable cost. Sometimes we have some costs which is not either fixed cost or variable cost. So where do you put that one? We have costs called steep cost. So steep cost, at a point it behaves like a fixed cost, and then at another point it behaves like variable cost. So you cannot always segregate it. Then fixed costs will remain constant. Are you sure fixed costs will remain constant throughout? Some costs, okay, fixed costs will remain constant. Then at a point, it changes to what? Variable costs. Like the steep cost, it would remain constant for some time, then to change to variable cost. Then variable costs will vary proportionately. This is invalid assumption, especially where there is a diseconomies of scale or economies of scale. We have economies of scale. They have diseconomies of scale, right? Do you remember those concepts? Have you heard of them before?
Yes, by a very long time. Okay.
So economies of scale is like if you are going to cook food, your ingredients are not many, okay? But because you are a good cook, you are able to cook more plenty food than someone who even have more ingredients. You are using fewer resources to generate more outcome or to generate more volume. So because of economies of scale, if you are producing in large quantity, the cost per unit will decrease because of the way you are more efficient in production. So your cost per unit will decrease. So if the cost per unit will decrease, then it means that if you still know one, so the cost per unit will be the same, okay? But when you multiply it by the number of units, the cost you should have gotten as your total cost, because of economies of scale, the cost you will actually get will be lesser than the cost you should have gotten. So assuming you produce 100 units and the cost per unit is 5, you should have gotten 500. But because of the economies of scale, you are actually getting 450. So it means the variable costs will not, because the variable cost should have 500, but because of economies of scale, the variable cost is lesser than 500. So therefore, this assumption the variable cost will vary proportionately, okay, isn't correct sometimes. The same way we have this economies of scale. Ideally, your 105 should have given you 500 units, 500 costs. But some of the resources, some of the your capacity is either obsolete or you are not able to utilize them well, and therefore the costs of maintenance and others will increase the cost above 500 cities. So you are incurring cost of 600. Ideally, you should have got to 500. So if that is the case, you are incurring diseconomies of scale. So if you overstretch your capacity, okay, you overstretch your capacity, you will incur more additional costs, and therefore it will not give you absolute 500, but more than 500 cost. And therefore, the assumption that variable costs will vary proportionately is invalid. Then variable cost per unit is constant. In reality, variable cost per unit is not constant. The same way price level is not also constant. Okay, so I think so that is it. So the uses of break-even analysis, we use it to determine the selling price, okay, that we can sell. We also use it to determine the cost and volume at different output levels. Okay, so at different output level, we know that this is the cost, this is the volume. That's the formulas we are coming to use. They will also use it to determine the quantity of goods that we should produce in order to break even. So how much do we have to produce to break even? We also use it to determine the effects of changes in a selling price or price differentiation. Okay, so if the price change, what will happen? Because the price help us to know the volume and the revenue. So if it changes, what will happen? So we use the price and then the selling price and then variable cost to know the contribution. So the price change, what will happen? Then it can be used to examine the impact on changes, the impact of changes in fixed and variable cost. So you know that fixed cost and variable cost is part of the formula. So if we change the fixed cost, what is going to happen? If we change the variable cost, is going to happen? So the limitation of break-even analysis we have just looked at, they are here. So they are the same thing that we just discussed. So we have two approaches to break-even analysis. We have the graphical approach, and then we have the mathematical approach or equation approach. So graphical approach is where you draw the break-even analysis, okay, in a graph, and then the graph, using the graph, you can trace to the quantities and then to the sales figures. So those columns will help you determine the break-even point in units and then in sales, and then you know your margin of safety in units and in sales. Okay, so if you don't want to do that, you quote formulas, and that is the equation approach. So with the graphical approach, when you do it, you should be able to come out with something like this. So you have these charts. You have these charts. I know you have done it, right? At the SHS level. Do you remember using a graph sheet to draw break-even analysis? Who did that before? I'll ask you, I'm not asking you to explain. Whether you remember you use graph sheet to do it. And so Danny, you okay. All right, so we have the unit column here, and then we have the CD equivalent here. Now you have the cost and volume as expressed in CDs. Then the units, okay, is the quantity. When you are not producing anything, you will still incur fixed cost, right? If you are not producing anything, you may still have fixed cost because you have set up the production, but you did not start production. So therefore, the setup cost, including the assets, all the assets you have, building, machines, they are the fixed cost. So you start from that fixed cost. Then when you begin to produce, the fixed cost will not change. So the fixed cost will be the same as you are producing. That's why we say fixed cost is fixed throughout. Now, when you begin to produce, you would incur additional costs, right? You incur a variable cost. So if you add the variable cost to the fixed cost, you will get this line above the fixed cost. As the production increases, the line will continue to rise. So the between this line and fixed cost is the variable cost. Then fixed cost plus the variable cost will give you the total cost. So the total cost line will be above the fixed cost at any point, okay, except when the production is zero, when they are equal. So it will be above the fixed cost, then it is going. As you also start producing, you will need to also sell. So then the sales will also start from zero. When you are not producing anything, the sales is what? Zero. So when you begin to produce, the sales will also begin to rise, right? Will begin to rise. So until you get to where your total revenue, so the sales figure here, the sales line is the total revenue. As it is rising, okay, then it will go and meet the total cost line. So the total revenue line and the total cost line will meet each other. So where they meet is what we call break-even point. Then you trace that break-even point down to the units and you get break-even point in units. Then you trace again to the CD sign, you get break-even point in value. So you know that if you want to make profit, you don't have to produce less than 80,000 units. So you must produce above 80,000 units in order to make profits. So that is it. Then the question is, what happens? Should I continue to produce like above 120,000 and going? Does it make any economic sense to continue to produce? So then you will see that there is a need to know what is the limits of the production above the 80,000. Then we look at, okay, when we continue to produce, are we able to sell everything or not? So there is the need to be sure of where we should produce up to and be safe. Where we should produce up to and be safe. So let's find our margin of safety. So we assume that, okay, when we produced up to 120, we can sell all. But anything above 120, we are not able to sell all. Then we say that, okay, then our margin of safety is 120. So the margin of safety line, you trace it. So you trace the margin of safety line here to the total revenue. Okay, you trace it to the total revenue. Then between 80 and 120, that is margin of safety. Then you can also trace it to the CD sign. Okay, if you assume you trace it and it's 12 or 11, between 8 and 11, that is margin of safety. Then you can do margin of safety in value and the margin of safety in CD. So margin of safety in value will be here. The margin of safety in quantity will also be here. You can trace, you can do calculation, okay, to know the percentage of margin of safety. So this is the graphical approach if you don't want to do the calculation. Any question before we move to the calculation? Any question? Are you all okay?
Yes, please.
Yes, sir.
Okay. If you are not okay, don't let someone answer for you. All right, so let's move to equation approach. So with the equation approach, we are just simply going to use formulas to do the equation approach.
Hello, can you hear him?
No,
Please, then if you have his contact, notify him. Maybe he's not aware.
He has muted himself, so you can.
Okay,
Yes,
okay.
sorry for that. Okay, so the equation is what we are going to your exams will be based on the equation, not the graph. You don't want to worry with the graph. So you need to know all the formulas. So the formulas, so we have break-even point in units. So this is break-even point in units. Okay, I hope you follow me. So break-even point in units, the formula is fixed cost over selling price minus variable cost. Okay, so selling price minus variable cost should give you contribution. Okay, how do you get contribution? How do you get contribution? I just said it too.
So you said the selling price minus variable cost gives us contribution.
Good. Selling price minus variable cost should give us contribution. So who can state break-even point in unit without using this one?
It's
so
fixed cost divided by contribution.
Good. So fixed cost divided by contribution. That is a break-even point in units. So if you want break-even point in sales or value, you just multiply what you have gotten here by selling price. Right? So what is break-even point in sales formula? Break-even point in sales formula.
so fixed cost over selling price per unit minus variable cost per unit times selling price per unit.
Good. Good. So that is it. So that is that one. The next one is break-even point in values or sales. So we have just, let me give you the one. So this one, so this is the one she just said. So break-even point in cedis or value or in sales. So fixed cost over selling price minus variable cost times selling price. Okay, so these are the two formulas we have gotten so far. Now the next one is that sometimes you may not be given straight away selling price and variable costs. So let's go to this one before we come back. So contribution. Okay, contribution. So what did we say is the formula of contribution?
You said selling price per unit minus variable cost per unit.
Cost per unit.
Good. selling price minus variable cost should give you contribution. Now we also want to know contribution margin ratio. Okay, contribution margin ratio. So the contribution that she just said, okay, is coming from selling price minus variable cost, right? So if you want to know the contribution margin ratio, the answer you have gotten as contribution, just divide it by selling price. So if you are asked contribution margin ratio, it is contribution over selling price. Now, sometimes you may be asked to calculate the value break-even point in sales or value, where you are not given selling price minus variable cost, but you are given contribution margin ratio, especially the mixed products that we will look at later. So in that case, to get your break-even point in value, you will just take fixed cost over contribution margin ratio. Okay, please, are you with me?
Yes, sir.
Here we are flowing.
All right. So break-even point in value where the selling price and variable cost is not known, you go for contribution margin ratio. So fixed cost over contribution margin ratio. Then break-even point in value where selling price and variable cost is known will be fixed cost over contribution or fixed cost over selling price minus variable cost times selling price. Then contribution itself is contribution of over selling price. Now we move on where in the situation where, because you said break-even is a tool that is used for making decisions about the price, about the quantity you need to produce to break even, about the amounts of sales you need to make to break even, about the profit you want to achieve. So you can predict in the future the profit you want to achieve. That is what you call target profit. Then you may also take care of the profits by paying off the taxes. Okay. Now, if you want to break even, okay, so now you have made a break even. So if you made a break even, then the question is at what is the profit I want to make? How many units should I produce to get that profit? Because at break even you are making zero profit. Now you say, okay, if I can produce this number of units and I would break even, then when I increase the units, I'll make profits. But I want to make a target profit, So if I want to make a target profit, now you know the profit you want to make. Then how many units should you produce in order to make that target profit? So with break-even analysis, where there is target profit, and you are looking for the units, okay, it's the same formula you have you know already, okay, but this time around, the only thing you are introducing is the target profit to the fixed cost. So it will be fixed cost plus target profit over contribution, or fixed cost plus target profit over selling price minus variable cost, all the same. That is where you have target profit, and then you are talking about units. In the same way, you still have target profit, and then you want to know the sales. So simply what you do is that the answer you have gotten here, you multiply by selling price. So it is going to be fixed cost plus target profit, okay, over selling price minus variable cost times selling price. So the answer you have got in the first number 3, you multiply by SP, and then you get target profits break-even point in sales or in value. In value. So if you are also not giving selling price and then variable cost, and you are giving contribution margin ratio, okay, you can take it fixed cost over target profit over contribution margin ratio. All right, that is number 4, 3, and 4. Then number 5. Now you know your target profit. You say you are setting target profit, but the point is that profit you are setting, you will not enjoy the profit alone. You have to pay the profit. You have to pay taxes on that profit, because we know in accounting that anytime we make profit, we must pay tax for the government. Okay, we must pay tax. So we said, okay, I still want to predict the profit I want to make in the future after paying off the taxes. Okay, my profit I want to make in the future. The first formula we did was that profit that I want to make, after making that profit, then I'll pay taxes. But this one is, okay, I want to make that profit after paying off the taxes. So in that case, we have target profits, okay, where there is tax, okay, where there is tax. So we want to know the break-even point in units, okay, with the target profit where there is tax. Now, and here is in units. Here is in units. So if you get the units and you are looking for sales, you just multiply by SP. Now, you will still have the same formula. This cost, okay, plus target profit over selling price minus variable cost. However, this target profit should be with, okay, after paying off the taxes. After paying off the taxes. Okay, after paying off the taxes. Now, these target profits that you are talking about is after tax, but we need to gross up. We need to gross up the tax, the target profits, so that we add it to fixed cost. So in grossing it up, okay, we'll just take that target profit and divide it by 1 minus T, where T is tax. 1 minus T, where T is tax. Okay. 1 minus T, where T is tax. So for instance, okay, if the target profit is to make 5,000 and then the tax is 25%. So you need to gross up the 5,000. That is after paying tax. So you have made a certain profits and you pay tax of 25% and you are now having 5,000. The question is, how much was the gross amount with that tax? So you just simply take 5,000 and divide it by 1 minus T, where T is 25%. So it will be 1 minus 25, 1 minus 0.25. So 1 minus 0.25 should give you 0.75. So in order to know, to gross it, to grow the 5,000 up, you take 5,000 over 0.25, 0.75, and then you get your gross amount. What are you going to get? So 5,000 divided by 0.75. How much are you getting? Please, how much are you getting? This class, you have to come with your calculators or phones. Phone calculators in the phone.
So you said 5,000 divided by
0.75.
75 is 666.6.
Okay, so 6,667. So 6,667. It means that you made a profit of 6,667 and you paid tax of 25%. You are now left with 5,000. Is that okay? Another example. So you people should calculate it. You people should calculate it. Now, if I want to make a target profit of 120,000, 120,000, and the tax is 30%. The tax is 30%. So what is the gross profits? What is the gross profit? Or profit before tax?
Please,
Yes, sir.
I had 171,429.
That's good. That's good. Who is confused? You people, I have seen your problem. You are hiding. You'll be hiding. Exams day, you will see.
Me.
Please, can you come again? She says she's not clear. Can you explain how you got that?
The tax rate is 30%. So if you convert 30% into decimal, I think it's 0.3. So if you subtract 0.3 from 1, you get 0.7. So the profit divided by 0.7, which is 120,000 divided by 0.7. That will give you the answer. 171,429. Yes.
Okay. Do you understand, Juliana?
Yes, sir.
Okay, so I'll give you another question. If I want to make profit of 100,000 and the tax is 25%. So I want to make profit after tax of 100,000 and the tax is 25%. What is the gross profits or profit before tax?
$133,333.
Who has confirmed that?
Confirm, Doc.
Okay. Who is confused? Nobody. Okay, so now I give you a complete question. So, okay, before then, so when you get that answer, that becomes everything in the bracket here. Then you add it to fixed cost and then subtract, and divide it by contribution. So write this down. Write this. So fixed cost is 120,000. Target profits after tax is 150,000. Selling price is 20 cedis. Variable costs is 12 cedis. Tax, corporate tax for Ghana is 25%. So question is find break-even point in unit, then break-even point in sales. Shall I repeat the question?
Yes, sir.
I don't have the question, I heard it. So if I said target profit, sorry, fixed cost is 150,000. Fixed cost is what?
No, 120,000.
120,000. Then target profit is 150,000, right?
Yes, right.
Selling price is 20. Variable cost is 12. Tax is what?
25%.
25%. So what is the break-even point in units? And then break-even point in sales? So 5 minutes. Please, are you done?
Yes, please.
Yes.
Okay. And you take us through what you have done. What's the final fix? What's the break-even point in unit 2?
I had 15,000.
What about others? Who confirms that? So take us through what you did to get the 15,000.
The formula was fixed cost divided by selling price minus a variable cost.
Mhm,
And the fixed cost was 120,000.
mhm.
And the selling price is 20. And then the variable cost is 12. So I had 120,000 divided by 8, and I had the 15,000.
What was the target profits?
It
Target
was
profit was
150,000,
there. What is the tax?
25%.
So 150,000 over 0.275. What did you get? Or you ignore that one?
Yes.
Can you ignore that? What was fees cost? 120,000, right?
Sure.
What was the contribution?
Contribution was 8.
So you should get, so you can't ignore that one. The rest, what did you do?
I got 40,000.
Okay, I think 40,000 is correct. How did you get the 40,000? Sana,
This was 120,000 plus 150,000 divided by 0.75 or divided by contribution 8.
so,
So,
mhm.
so I got 320,000 divided by 8. And answer is 40,000.
Okay, but be careful the way you treat the target profits. Do the target profits first before you add it to fixed cost.
Oh,
Otherwise, calculator will deceive you. So tell us how you did the target profit first and what did you get for that one, the gross up.
the target profit 150,000 divided by 1 minus represents 25%. That's 0.25. So I
Okay,
got 150,000 divided by 1 minus 0.25. So I got 0.75. 250,000 divided by 0.75. So 150,000 divided by 0.75, I got 200,000.
okay, okay. So you got 200,000. Then continue.
So I add 200,000 to the fixed cost.
Okay.
That's 120,000
Mm-hmm.
divided by 8, the contribution.
Okay.
So 120,000 plus 200,000, I got 320,000 divided by 8.
Okay.
So that's like 40,000.
All right. That is good. So The rest, are you okay? Or you need clarification? Don't be quiet too. All right. So what is the break-even point in sales? The
600,000.
600. How did you get the 600,000?
800,000.
Yes. How did you get the 600,000?
800,000.
800,000. Sorry. So how did you get the 800,000? Hmm? Explain to us.
I also had 800,000. Can I explain?
Yes. Go ahead.
Okay. So I found the target profits, which we did the first one. So the first the target profit that we had 200,000, and I added to the fixed cost. I added to the fixed cost, then I divided by the contribution times the selling price, and I had 800,000.
Okay. But there is shortcuts to that.
Yes. So the shortcuts, I just multiply the first one by the 20.
Okay. So that is it's 40,000 times 20. So you get 80,000. All right. So the next is break-even points. Sorry, multiple products. So for the multiple products, we are going to look at the weighted average contribution margin ratio. Then when we get that, then you take fixed cost over that. So for the multiple products, the major problem is to calculate weighted average contribution margin ratio. So you need to follow 8 steps, 8 good steps to calculate that. So let's see if when I send it to you, you can follow that to look at the steps that you do to calculate that. Then break-even points with margin of safety. Okay. So the formula is that you can find margin of safety in units. You can also find margin of safety in value, and then you can also find margin of safety in percentage. So with the margin of safety in units, it is actual sales minus break-even points, break-even sales. Actual sales minus break-even sales. The margin of safety in units, actual sales in units, sorry, in value. Actual sales in value minus break-even point in value. The margin of safety in units, actual sales in units minus break-even point in units. The margin of safety in percentage, okay? So margin of safety in unit, and so you can do in percentage for both units and then in value. So here, margin of safety in value, which you have already calculated here. So the answer you have gotten here, you just divide that answer by actual sales. So margin of safety in value, then over actual sales in value times 100%. Times 100%. All right, so that's it. As for this one, don't worry yourself about degree of operating leverage. Now, let me give you this question. I hope you will not spend so much time. Okay, so let me leave it. When I give it to you, let me let you calculate it. I hope you are looking at the answers. Okay, so the question is here. So this is your question, right? Can you see my screen well?
Yes, sir.
So you read the question among yourself, you discuss it among yourself and solve it, right? You discuss it among yourself and solve all the questions A to F. Then when you are done, you let me know. Then I'll come on so that we would continue. When is the class ending? Is it 11 o'clock?
11.
Okay. So how many minutes do you need for this question?
We can't predict.
Okay, so then start. Please, all of you should participate too. You are doing this discussion among yourself and you are solving it together. When you are done, then you let me know. All right, so you can start now.
Hello.
Hello.
Hello. Please, Senor, please lead there. Hello, Senor.
Someone should read the question for us.
Pardon?
Someone should read the question for us.
Okay. Okay, then I'll read. Lithium Enterprise make a single product with a sale price of 100 Ghana cedis and the marginal cost of 60 Ghana cedis fixed 60 Ghana cedis. Fixed costs are 60,000 Ghana cedis per annum. Calculate A, number of units to break even. B, sales value at break even. C, contribution to sales ratio. D, what number of units will need to be sold to achieve? Yes, hello, Senor.
Yeah,
Your hand is up. I'm reading. Okay.
sorry.
Okay. So D, what number of units will need to be sold to achieve a profit of 20,000 Ghana cedis per annum? E, if the tax rate is 25%, how many units and sales value will be needed to make a profit after tax of 20,000 Ghana cedis. F. Because of increasing costs, the marginal cost is expected to rise to 65 cedis per unit, and the fixed cost of 75,000 Ghana cedis per annum. If the selling price cannot be increased, what will be the number of units required to maintain a profit of 20,000 Ghana cedis per annum? Okay, please, I've finished.
Okay.
Hello, hello.
Hi. I think we don't hear from Senyo.
Please, then, Danny, please lead that because we can't hear.
Is he solving before? Because his mic is also off. Is he solving it before? Hello,
I
Senyo.
think maybe we can discuss, then we look at how to.
Okay. Okay.
I don't know whether, so at least he has to just pilot it so that we'll discuss. Maybe when we discuss the A, we go to the next one. And
So, what is the formula of break even in units?
Fixed cost over selling price minus variable cost. Oh, please, I thought we are doing it together.
Yes,
Yeah,
that was
so now we have to know our formula for this point, break-even point in units. What's the formula?
I think the break-even point in units is what Auntie Rita said. It's a cost, um, fixed cost plus target profits over selling price minus variable cost. Is that not it?
No, we haven't read that.
I said
anywhere.
fixed costs over selling price minus variable cost.
Yeah.
Oh, okay.
So now fixed cost is 60,000 over our selling price is 100. And our variable cost is 60. So now we don't have variable cost. We only have marginal cost. So now we have to find a variable cost. How are you going to find a variable cost?
Please, the marginal cost is the same as the variable cost.
I don't think they are the same.
Yeah.
No, they are not the same.
Now, how do you determine the variable cost from the marginal cost? So then we should try to define marginal cost. What is marginal cost?
The marginal cost, additional cost incurred when additional rate is added.
Senor, we are listening to you.
Now, how are you going to get the variable cost using the marginal cost and the selling price?
Well, he said that the selling price minus the variable cost is the same as contribution.
Yes.
Sure.
Yeah. And with the question, it says that a single product sale is of the single product sale of price is 100 cedis, and the marginal cost for a marginal cost of 60 cedis fixed, 60 cedis. So if we want to get the contribution, don't you think that we have to look at the selling price and then the marginal cost? We subtract the selling price from the marginal cost, then we will get the contribution.
If you do that, then you are regarding marginal cost as variable cost. So I think you give an alternative formula, or the contribution margin ratio. How is it derived?
Contribution margin.
I didn't copy all the formulas, right?
The contribution margin ratio was contribution over selling price.
Contribution over selling price. We have two right here. Wow. Then are you around?
I'm around.
Yeah, happy with the solution. How to derive there?
Is the law around? I can't hear
Contribution.
him. The law.
I don't think he is here.
Oh, okay.
I think what Julie said could be the solution. That to get the contribution, you have to take the 60 from the 100. You have to take the margin cost from the selling price to get the contribution.
Okay, then let's move ahead. In that case, we are regarding marginal cost the same as variable cost. So without that, we can move ahead, or
Yes. So let's use it. Money who catches the money we will bear my mind.
So now you have our fixed cost as 60,000. We got our selling price is
Hello.
so now we are you. Hello.
So now the contribution. The contribution will have the selling price minus the marginal cost.
Okay.
So it will be 100 cedis minus 60 cedis. Then we get 40. So that would be the contribution.
Sure.
So then we will come and use it for the A. So it will be fixed cost over the contribution. Okay. So and then the fixed cost is 60,000 Ghana cedis. We have 60,000 Ghana cedis divided by the contribution, that is the 40. So it's 1,500.
Yes, I've had the same.
Yes.
Yes, 1,500.
100 units.
1,500 units. Okay. So now we go to the B.
Yes.
Yes.
We have sales value at break even. And then the sales value. Please, you remember the formula at
I
break
think,
even?
I think we can use the start. We can
Pardon?
use the start.
Please, we can use what?
As the first one, A, but you multiply by the selling price, that's all. You multiply by 100.
Okay.
So I got
Oh.
150,000.
Yes, it's right.
Okay. Okay. Auntie Rita, you said you had how much?
150,000.
150,000. Okay.
Yes.
Let's had it. Okay. Please, are we all true?
Yes.
Okay. So let's go to the C. That's the contribution to sale ratio. So the contribution to sales ratio, you said the contribution over selling price. Is that not it?
Yes. Times 100.
Times 100. So please, what do you get?
Please, someone should confirm the formula for, is it times 100?
No, because
Yeah, times 100.
is it times 100? Is it 100% or just 100?
100%.
I think times 100.
100%. Okay, okay. So it will be 40.
Yes.
Yes.
And we go to the D. So what number of units will need to be sold to achieve a profit of 20,000 per annum? So this one, what are we going to do?
I think we are finding the target profit break even in units, or
Yes, I think so.
Okay. Okay.
But with this one, there's no tax element, so I think we don't have to consider a tax here.
This one.
Yes.
Budget.
We can use that has tax element.
So it means that we will just divide it by 1. Or
I think this one we use the formula fixed cost over contribution plus the target profits.
In fixed cost plus target profit divided by contribution.
Divided by contribution, right?
Yes.
okay, fixed cost plus target profits divided by contribution.
By contribution. I had 2,000.
Okay. We are still on it, so let's see whether we can confirm that.
Confirm 2,000 units.
Senor, please, did you also get it?
Yes, 2,000.
Okay. Uncle Daniel, Naku, please, are you there?
Yeah, I also have 2,000 units.
Okay. Okay, so I also had 2,000 units. Okay, so please let's continue with the E. So the E also says that if the tax rate is 25%, how many units in sales value will be needed to make a profit after tax of 20,000? So now we are looking at the targeted profits with tax, eh?
Yes.
Sure.
Okay.
Okay, so I think we are finding both the units and the sales value.
Yes.
Okay, so the units I had 21667.
Mm-hmm.
Wow.
Please, another confirmation.
You said you had what?
I had 21667.
It's correct. Confirm.
Okay.
That's
So
the target. That's the target profit.
no, that's the E. The units we have to produce.
Units.
Okay,
Units.
okay.
So with the sales, we need to multiply this by the selling price.
Selling
Or
price.
Yes,
Yes.
you're right.
which is 2166700. Or
Yes, correct. 217 times 100. Correct.
another.
Listen, I'm getting a little bit confused with the tax. That's the units that we are coming to use.
Yes.
How much did you get?
With the tax, I got 21667.
21667. Better one, we will find the target profit first.
Yes.
Yes.
Okay. And the target profit, how much did you get?
The target profit is 20,000.
You got 20. Okay, so that's what I wanted. Okay.
Rita,
Yes.
with a fund answer, I say you have 215,700. Is that it?
200.
15,700.
Which one? The units or the sales?
The two.
The sales, I had 216,700.
216,700.
700.
Okay, correct. 216,700. Okay. Then look at it.
As in 2,166,700. Is that correct? Hello.
Yeah, please We are still on it, so
Danny was speaking to it.
okay.
21, 57 times 100. Let's say you had it in minute. Mine is 216,700, though, but you say yours is in millions, huh?
Please let me.
Hello.
Yeah.
Hi.
In units, I had 2,166.67.
Is it 0.67?
Yeah, 0.67.
So you run it.
1,167, so that point, you make it to the nearest whole number.
Okay, so it will be 2,167.
Exactly, yeah, I had the same thing.
Okay.
So the selling price is 100, so you multiply the same amount by the same quantity by 100.
Okay.
And you are supposed to have
Okay.
216,700.
Okay,
Andrew,
I'm going over. I'm a little bit confused.
I'm also getting
That
confused
you
here.
multiply by the selling price 100. What do you
Please, Danny,
Yes, please.
with the units, please mention the figures for me and let me see.
Give me the answer.
Okay.
The
I-
yes, the figure. So it will be 60,000
plus
60,000 plus 20,000.
20,000.
Yeah, divided by.
But you must flat
You
into
must do
bracket.
that.
You must put it.
Yes,
20,000
you
into bracket.
pardon?
What? It's 60,000 plus
Mm-hmm.
bracket between.
Okay.
Then 20,000. Then you divide by 1 minus 0.25, which is the tax rate.
Okay.
So if you manipulate the figures in the bracket, you are going to get 20,000 divided by 0.75.
Mm-hmm.
The rest you manipulate, you're supposed to get 2,167 units.
Okay.
Okay, but the F is the it's a top factor.
So I think with the F, we are now the face price. We not use the old face price.
Okay.
This time we are using the 75,000.
I think so.
So I think the formula will be the face price, that's the new price, plus the target profits, which is 20,000, and then divided by the contribution.
Yeah. So there's no tax element, right?
Yes.
Okay. Let's go by that.
And I think now the contribution too will change.
Yeah, it will change because the marginal cost increase
Yes,
to 65 per unit.
Yes.
So what is the contribution now?
So it's 100 minus 55, or which will give a 35.
35, right?
35.
100 minus 55.
So I had 2714 units.
Yeah,
Confirm.
I just hope we have done the right thing.
Yes, provided that marginal position available.
Because to discourage us from going through all this stress, we get it wrong.
Yes, and I checked on ChatGPT. I think it regarded the marginal cost as variable cost. So we may be right.
Okay, so should we alert him that we are done?
Please, I'm not done.
Let's do for all of us.
I was-
Otherwise, you may
Okay.
ask
Yes,
everybody
I was
Okay,
I was lost somewhere.
okay. So if you are done, raise up your hand for us to know those that we are still waiting.
How many are we? We are 9. Okay.
Yeah, Nanai.
Okay. So with the F, we are calculating for it says that the marginal cost for the unit.
We are calculating for the units we need to produce in order to obtain the profit of 20,000.
Okay.
Assuming the fixed cost increase to 75,000 and the marginal cost increase to 65 cities.
Okay.
It seems only 3 of us are active here. The rest, are they sleeping or they are eating?
So the first cost was 70.
Okay, let me check. How about we? Abukar Anthony.
Abukar, no network.
Daniel Naku. Naku. Hey. Danny Lai.
Okay, so please call him. I'm done.
You are done. Eh?
Yeah.
But we haven't heard from the rest, so whether they've also finished.
But they are not.
I'm here, but my environment is not conducive. That's why.
Look, who is speaking? Danny Lai there.
Yes.
Okay. So you are done. Okay. Then let's call the lecturer. That's, I think, the rest you can't reach them. No one knows to which side. Richard,
Yes.
please inform the lecturer that we are ready. We are finished.
Okay.
So Danny, please, the units. How much did you get?
I had 2,714 units.
Okay.
Yeah, to the whole nearest whole number because you get decimal point that it doesn't match up to one. So
Okay.
So please confirm your answers from the solution.
correct.
So for A to D, did you get the same thing?
Yes, please.
Yes, sir.
Yes, sir.
Then D to F. Did you get the same thing?
Better.
Please, I think the answers are supposed to be two in one. Or
Please, our F here, our E here is your F. So I'm confused.
Or you didn't have some of the questions?
And our F is your G.
yes.
Okay. Yes, but look for the answers.
But the answers are correct.
Okay. So now another task for you. So read and discuss and solve it. So please, someone should read, then you continue your discussion.
Hello.
Yeah.
Okay, sorry.
I had some issue with my phone.
Okay.
All right. Mana Industries sold 150,000 units of each product at 20 cedis per unit. Variable costs are 15 Ghana cedi per unit. That's manufacturing cost of 12 cedis and selling expenses of 3 cedis. Fixed costs are incurred uniformly throughout the year, and they amount to 972,000 Ghana cedi. That is manufacturing cost of 600,000 Ghana cedi and selling expenses of 372,000 Ghana cedi. Now required, I calculate the break-even point in units and Ghana cedis. 2, calculate the number of units that must be sold to earn an income of 75,000 Ghana cedi before income tax. 3, calculate the number of units that must be sold to earn an after-tax profit of 10,000 Ghana cedi if the income tax rate is 25%. Okay. Sir. Sir, please, I'm done.
You said we should discuss.
Oh, it's not
So
around.
he
Okay.
said we should discuss, so lead us.
Okay. Okay, so we are required to calculate the break-even point in units and Ghana cedis. Okay, let me. Please excuse me. Come. Okay, so for the break-even, the break-even point in units and Ghana cedis, or and Ghana cedi rather, we have to look for the formula for the break-even, which is a fixed cost over the contribution margin. Then we try to do the division by taking the number. So please, may I ask, what is the fixed cost over here?
Please, my hand is up.
Okay.
Please, I wanted to find out with the I see units in Ghana city. Does it mean we are finding both the units and the sales value?
With the unit in, okay.
Yes, it's true.
See, let's look at the question. So it's 2 in 1.
Yeah, 2 in 1. You have to find
Yes.
the unit and its value.
Okay.
Okay. So please,
So with the unit, the selling price minus variable cost for the unit.
So here the first cost is 972,000.
Yeah.
Okay. All right. So I think that we have to compute it by putting it in the formula. And what is the contribution margin?
So here we are going to have the selling price minus variable cost. So with the selling price, my little idea, I think we have to multiply the units by the sales figure there. That's the 150,000 units by the 20 cedis to get the selling price.
Okay, I think the selling price have been given there to be 20 per unit.
By
That's
saying manner that
per
sold
unit.
per unit, so you have to multiply it by the units.
Hello.
Or
Hello.
Yeah.
I
Hello.
If you
think it
multiply, if you multiply, if you want to find the contribution, you multiply that way. It means when it comes to the variable cost, you must also multiply. But you cannot
exactly
use the per unit only to do it without multiplying.
without multiplying.
You get the same contribution. Yes.
Okay.
But my problem is, let's look at the component of the variable cost. It's the manufacturing cost plus and selling expenses. So the selling, are you supposed to include the selling expenses or you are supposed
No,
to
they
add
have
it?
put them together to get the variable cost. That's 12 plus 3.
So selling expenses is
get
part
the
of variable cost.
selling expenses.
Yes. The reason why they divided into
That's
two,
the manufacturing
cost, I understand.
cost and the selling expenses
So to
of
include the selling expenses. That's the point. That's the people. With the
Okay.
selling expenses, actually, it's part of what they call it, the overhead. Okay, the administration overhead, which should not be part of variable cost. It should normally be analyzed and like what direct cost. What do you say? You can also come out with it. Maybe
let's find out.
And I think it's part of it.
that it should be put in the variable cost. But under the making condition, I would have made it work.
But the variable cost, I think they've put it together.
Yes.
So it's part of it.
Please ask yourself, is it part of variable cost?
It's part too.
How?
I think it's part.
Yeah.
It's part, because looking at it now, variable costs are this, and then the manufacturing costs plus the selling expenses. That's the 3 cities. So they have put it together to get the variable cost.
Like, why do you think they separated it? Why do you think they separated it?
I think they wanted us to see what's the expenses that occur during the manufacturing cost, and then there's expenses that also occur during the selling cost. So when we put it together, then we are able to get the variable cost for the production.
So that's the manufacturing and the selling.
And yeah, and the selling expenses.
For the variable, okay.
Yeah.
So 12 plus 3.
Then we get the 15.
15, okay.
Yes. So it will be the selling price. That's the 20 minus 15.
Yeah. So that will be the contribution margin.
Yes, it will be the contribution margin.
So please, can we know the break-even point? The break-even. Yeah, since the
With the so the contribution margin, so with the break even, we said the formula is fixed cost over contribution.
yeah.
So then we get the unit of the break even. Auntie Rita,
Yes.
are we there?
I am.
Uncle Danny,
So please, if you have a calculator, let's see the when you divide it by 5 to be how much?
I got 194,400. So it's 19. Pardon?
194,403.
Pardon?
In unit, I got
Yes, we've been giving 600,000. Now it's 23,000. You have to.
Danny,
Okay.
please, I can't hear you. Is that what?
Yeah, so you got what? 194,400.
4,400. Yeah.
400. Okay, yeah, okay.
that's in unit, right?
Yes.
Yeah, which is the units. Yeah.
So it
So the
means
break
that the
even
Ghana city
in
is
Ghana
the
city
sales,
will be what?
the sales.
So
Oh,
in value, I got 3,888,000.
that's the
Yeah,
sales.
that will be
Yeah,
the
that's
in
sales
cities in Ghana city.
in value.
Yeah. Okay.
Please come again because I'm a little bit confused. In Ghana cities, no.
So what he's trying to say is that after multiplying the selling price by the unit, the one we have just got,
Yeah.
you are going to get the actual amount in Ghana city, which is the 3. You said it's what? 3.
Yeah, I got 3,888,000.
So that is the break even in Ghana city.
Okay, so when we finish, then we multiply it by the selling price.
Yes.
Yes.
So,
All right. So please, can we move to the next one?
Please, you say what did you get?
After multiplying by the selling price, that's 20. I got 3,888,000.
Okay.
Okay. So we go to the B.
Yes.
Yeah.
Okay. So we are going to calculate the number of units that must be sold to earn the income of 75,000 before tax.
So here, can we say that the 75,000 is a target profit?
Yes.
Okay.
Oh, Auntie Rita. Uncle Danny.
Yes, that's the target.
Yeah, I think that's it.
Hello, guys.
Hello.
So income and profit, are they the same?
Yes.
Okay.
So please, may I want to know to calculate the number of units that must be sold to earn an income of 75,000 before income tax. Are we going to say what
So
would be the formula for that?
we will use the formula for the units. That's fixed cost over the contribution. That's the selling price minus variable cost.
Okay.
Yes, Auntie Rita.
Please, Danny asks about whether the income and profits are the same.
Yeah.
They are not the same, but I don't know with this one it should be the same because income is different from profits. But I don't know with this whether we should use it the same. So for my little idea, the income it refers to the total revenue generated in selling. And then the profit is what you make after deducting your cost from your revenue.
Yes. So if you look at the hello, if you
Hello.
look at the third requirement, you see that one he based it on the profit of the tax.
Yeah.
So is there any information hidden that maybe you can use to derive the profit?
Okay, so we divide all by the cost margin per unit. And please, what did you get for the fixed costs and target income?
Which one?
I mean the II. We want to calculate the number of units that must be sold to earn an income of this before income tax.
So it doesn't mean that we will the 75,000 by 5. That's the contribution to get the units for that.
Okay.
I'm just asking because the way.
So based on the formula, now we have to add the target profit to the face cost. Then we divide it by the contribution.
Okay.
That's the 75,000.
Okay. So the
If
amount
the-
that we want to realize, we will be earned is that 75,000, right?
Yes.
Sure.
But the fix,
So does it mean that we will add it to the 972,000?
yeah,
Yes.
yeah. Since that is the amount,
The
the fixed cost,
fixed.
yes.
And okay, and this one is the targeted
Yeah.
profit. Okay.
And we declare.
Hello, Auntie Rita.
Please, I don't know if Danny asked that was suggesting that the selling expense wasn't part of the variable cost. But with the fixed cost, I see selling expenses. So I'm confused.
Yeah, so it is supposed that there's some expenses hidden somewhere. So that's why the inflation divided the different into.
Please, your voice is very far. I hardly hear you.
Yeah, it's my network. Oh. Hello, can you hear me?
Okay.
Yes.
I think that you see they want to give us a clue as to how we should go about the income. If you look at the variable cost, we have selling price elements, and the fixed cost we have selling price elements. Can't we add the two and subtract it from the income in order to get profit? Hello.
Yeah, I
You
think
add which
Yeah.
two is it? Okay.
I think there's also
Yes, because you say the three selling price, if you want to get the selling price, total selling price, you must multiply by the 150 to get the total selling expenses. But when it comes to manufacturing for the selling expenses is fixed, so we take that one and add it to it. That's a variable. We get the total expenses before we subtract it from the income.
you. I think we've come far, so maybe we should continue. If
When
dog comes,
Yes, when you can, maybe we need to clarify. Yeah.
so I think let's continue with our little idea.
okay, so we added 75,000 to the 972. Then we divide it by the contribution.
Yes.
Yeah.
You.
Please, I had 209,400.
Confirm. I got 209,400
Confirm.
units.
Okay, units.
Okay. So please, that represents what?
The II.
That is the target units for, okay, before tax. Okay.
So the units before tax.
Okay.
So that's
So
the
that will That will be units, right?
Yes.
Okay. So now let's move to, if we are okay with that, let's go to the third one. So it means that with the third one, we have to calculate the number of units that must be sold to earn an after-tax profit of 100,000 Ghana cedis. If the income tax rate is 25%. So how do we calculate for the?
So we use
So
the
first of
formula
all,
face cost plus the total of target profits divided by 1 minus the tax.
please again.
The face cost, which is 972,000, plus the target profit, which is 100,000. Then we divide it by 1 minus the tax, 0.25.
Oh, okay. So what is the fixed cost?
So the first cost is 972,000.
972,000. Okay. And we subtract from the. You subtract what from it?
Then we add the target profit, which is 100,000. So with the target profit 100,000, we are going to divide it by the 1 minus tax, which is 0.75. So let's calculate 100,000 divided by 0.75. Then we add it to the 972,000.
Okay.
Okay.
So it's
25.
3. Do you get that one?
Yo,
For the
I got 1,1,3,3,3,3,3.
oh, okay. Okay.
Okay.
I don't know how to.
So the after-tax profit was what? 100,000. Okay.
Yeah.
All right.
Mm-hmm.
All right. So we have. Is there any other questions? Some.
I got 221,066.67 units.
Which represents.
Please come again.
I got 221,066.67 units.
So run it.
So to be 221,067 units.
So
Confirm.
Please, how did you get this?
okay, so I think what you did was you add the after tax profits. When we calculated it, we had 1333333.333. Please, you have it.
Okay.
Yes.
Then you add the the fixed cost to it, that is 972,000.
Okay.
Then you divide it by the contribution, that is the 5.
Okay.
Okay, so
Okay.
when
To
you,
arrive at that.
yes, so
Okay.
you so when you, yeah.
So that unit is representing the
Yes, so you said we should calculate the
target
number of
units.
units, yes, to be sold to
Okay.
end that way. So that is,
Okay.
I think we are done. Let's call him so that we will see whether we're on course, so that we fix that confusion that arrived in it.
Okay, please do call.
Thank you, Wami. Please go.
Okay, so this is the solution.
Means we were on course.
Okay. You are right. Please kindly share it for us to go through again. Rita,
Yes.
yeah, please, I'm saying you can share it for us to.
It's dog who is
Oh, okay.
who is in it. So when
That will be later.
yes.
Yes. But we have done well. I'm happy.
But dog, please explain the questions more for us because we're a little bit confused.
And so, yeah, it is not marginal and absorption cost. It's only marginal and absorption cost costing that you would segregate between product manufacturing costs and other costs. And the manufacturing variable cost, the manufacturing cost per unit, right? That is even the absorption cost. So the rest of the cost accounting and management accounting is treated like marginal costing, or so it's not treated like marginal costing. Where so if you see any variable cost, it's variable cost, whether it is manufacturing or it is selling, they are all variable costs. So this is just splitted to make you overthink. Okay, so you ignore them and then go for the 15 cedis as the total variable cost. So the same way, you ignore the fixed costs and then go for the total fixed cost. In break-even analysis, we are considering the total fixed cost and then the total variable cost. So if you take out the selling expenses and you come and tell us that you are breaking even at this point, who is going to pay for the selling expenses? So that's it. What you have done is the right thing. Is that okay?
Yes. Okay, please up. The B,
All right.
the II.
Mm-hmm.
It's based on income, but you're taking it through profit. So when you saw the income, we're a bit.
You don't be mechanical. You just have to be flexible. Sometimes you check around, okay? If you check around the things that are available, you make decision based on that. In the same question, the profit was not given to you. So the wisest decision to take is to take income as profits. Right? And it did not even end there. It says that before income tax. Is it not profit for the year that is calculated before income tax? So don't worry, just change of names and other listen. Yes, Rita.
Sir, please, my confusion was to the selling price, whether we should multiply by the unit produced or
So if you multiply by the, what are you getting? To get the sales. So
to get it.
yes, so the units produced, you see that you have no use it anywhere, right?
Yes.
In break even, we don't multiply selling price by unit produced. We do our own calculations. We are not talking about unit produced, okay? So we are talking about these units. How many of the units should you produce to break even? So, okay. So how many of the units do you produce to break even? And then how many of the units do you produce to make profit of 75,000? How many of the units do you produce to make after tax profit of 100,000? That is our focus. It's not about what we have produced. Okay.
Okay, sir.
So this, what we have produced, is irrelevant in this question. Any other question? Yeah, okay.
Yes, for this calculation, we are okay.
Okay.
And I want to find out, please, the pre-tax income. I mean, the unit after tax. I want to find out the formula. Said is what the tax.
Yes, so the formula is here. This one, number 5. Target profits.
Okay, so the fixed cost plus the targeted profit. Okay. So the one there is always constant.
It is all over. Target profit over 1 minus T.
1 okay.
1 is coming from 100%. Okay. So if tax is 25%, it will be 100% minus 25%.
Okay.
100 minus 25, what are you getting?
That would be
75.
75, yeah.
So 75% is the same as 0.75. So 1 day is 100%.
Okay. Thank you.
You're welcome. So I will say that the next question you are supposed to look at, I know maybe you have to find another time on your own, okay? And discuss question 3. Discuss question 3. I'll send you the document, the break-even analysis with the answers. But make sure you discuss question 3. Okay?
Okay, sir.
All right. If you don't understand it, look at the solution. Then explain around yourselves. So I think that is all for break-even analysis.
All right.
Those of you who want to learn further, there is multi-product here. So multi-product is here. So we have 8 steps that you need to follow in calculating the multi-products. So if you go through, yeah, I'm sure you'll get it. If you don't get it, our next meeting, you ask me, then I'll explain it. All right. So that is all. So I'm going to send you everything here. Copy this and send it to you. Okay. So our next topic will be relevant costs. You can be reading around it. Okay, so if you don't have anything, we can end the class. I think we have done what we can.
Okay, sir, please, can we have the slide so that it will
Yes,
guide us?
that's what I'm sending to you now.
All right, thank you.
You're welcome. Okay, so I've sent it. Have a good day.
Thank you,
Okay,
sir.
same to you.